Let's get straight to it. From the numbers that you've seen and the conversations you've had, how do you feel about the state of the global economy?
Yeah, look, a very good question to start with. And I guess the way we described at the moment is if you look at what's happening, one of the big growth engines in China is starting to fire up coming out of COVID-19. It's fair to say when you look at all the PMI indexes, they're far in advance of all the other economies. We would expect as you get towards the end of the calendar year, this year, you'll start to see other countries such as India, the EU and the US start to stage recoveries. In saying that, we're very focused at South32 that lots of the commodities we are developing now for the future are very much still going to be needed by many economies as they continue to actually develop their own country and move people out of poverty.
Good morning to you, Graham. It's Manus. And that is about shifting the complex of commodities that you look after. Just to carry on, you see a recovery in China. In terms of the world opening up, you have global exposure to South Africa, Australia and South America. Are you back at full production, 100% return, or where are you on that journey?
Yeah, look, absolutely. I mean, if you think about COVID-19, there's always been two aspects that we focus on. One is the demand for our products, which is really driven by the impact on places like China or India. The second one is the health and well-being of our people, which is the priority. All our operations today are back to full capacity. Many of them are still battling some of the challenges around COVID-19 with their workforce in terms of protecting their health and well-being, but certainly we haven't seen a material impact to our production. And in fact, this year, if you think of the year just finished, 3 out of our operations set new production records, and also 9 out of our 10 operations decreased their actual operating costs. And if we think about the next period ahead, we believe our operations, the majority, will continue to reduce their operating costs and continue to increase their production as we see stronger demand for many of our products.
And Graham, let's talk about what is next, because you've warned on more volatility because of COVID-19. How are you preparing to navigate that road? Because you have the option, of course, of reviewing the portfolio of additional asset sales that could be on the agenda.
Yeah, look, we've started the journey to transform our asset base a period of time ago, and we're in the process of divesting our South African energy coal business, announced our divestment of Temco, and also closed Metalloys, which is a manganese alloy smelter in South Africa. At the same time, we've brought in new projects to the group, such as Arizona Mining, Ambler Metals in Alaska, Eagle Downs. So we're balancing it on both sides of the books. As we think about the current uncertainty, how we're protecting ourselves is to make sure that we continue to have a strong balance sheet, continuing to look at how we spend our own money in terms of OPEX and CAPEX. And clearly one of the reasons we suspended our buyback was the uncertainty that's sort of coming through from COVID-19. Until that's clear, we've been very careful about having a prudent and strong balance sheet. As we see prices continue to improve, we generate more cash. We'd look very quickly to get back out there to complete our buyback, which we extended today to give us that flexibility.
So, Graham, in terms of transforming the portfolio and looking what stays and what goes, obviously you have shifted on thermal coal. A lot of investors are looking at thermal coal. You're divesting there. On coking coal, you're still committed. And I just want to get a sense. You're actually growing in that area. ESG are becoming much more, I suppose, aggressive in their view. Are you fully committed to coking coal in the next 10 years? We heard from BHP in terms of their timeline. Just update us on that transformation.
So we have an existing operation today called Illawarra in New South Wales that produces coal. We're only about 3% of the seaborne export market, so we're not a big player in met coal. We do have a project called Eagle Downs in the Bowen Basin in Queensland. That is also going through a study phase at the moment with an investment decision due by the end of this calendar year. From our perspective, there is still a place for hard coking coal for a period of time, and we don't see that actually changing. In fact, the world needs it, or there will be no steel production, which has the other knock-on impacts. Longer term, 20 to 30 years down the track, you'll start to see hydrogen come into play, and the role of metallurgical coal and even potentially iron ore will change. But from our perspective, that's a couple of decades away.
I'd also like to get your view on what is happening in the battery sector, because you have been exploring some of the U.S. Clark deposits as a potential source of battery raw materials. I'm wondering whether, given the strength of your balance sheet, there's an opportunity for some more acquisitions and to be a little bit more aggressive on that front.
Yeah, look, we haven't changed our position that we've always looked at a bias towards base metals, and some of those could be used in battery technology. Some of them are also direct feeds, which to make lighter vehicles, lighter airplanes, that actually make you far more energy efficient and more green. And even little things like silver that's obviously used in solar panels. So that's why we have a bias towards base metals. We do believe in exploration and developing projects, which is where we spend most of our time and effort. M&A for us has always been opportunistic. It remains to be opportunistic. We'll only do it if we see value. We probably see there's a low likelihood of a value accretive M&A opportunity in the short term, though.
Graham, just want to get a sense from you as you look forward in terms of prices. Which commodities that you're in at the moment face the greatest price pressure as we trudge the road to normalisation? I don't think anybody knows where that really is, but where's the greatest price pressures going to come to bear in the hard commodity market?
Look, I think if you look across our complex, they're all slightly different. If I maybe take a couple of examples, alumina, we're seeing some upward pressure on alumina at the moment as Aug.20, the world's largest refinery in Brazil, is out for maintenance and losing probably about 35% of their capacity for 2 to 3 months. That's going to have a short-term impact for the next 3 months and probably push the alumina price up. We're also starting to see some upward pressure on met coal as a number of the, if you like, demand ex-China starts to grow again out of places like Japan and South Korea as they restart their blast furnaces, and as the actual Indians will come out of monsoon around September. So there are 2 of our 3 big commodities, if you like. We're already starting to see some movement upwards in price in terms of that pressure. I think longer term, we wouldn't change our view that base metals is the place to be, and that's really driven by not only a scarcity of supply and the grade degradation you see in existing operations, but it's also the strong demand that you'll see through consumerism, through the world moving to more of a green space.